Hi, good day and welcome to today's video. I am looking at Redstar Express audited full year numbers. These numbers were released, I think, 3 4 days ago on the NGX, so I opted to look at them. Now, my initial plan was I was going to do a potpourri video, meaning I'll take 3 4 companies and then do a bit of teaching on technical analysis. But I have been held up by the rains work-wise. It's been 3 days or 2.5 days of heavy rains in Lagos, and so that has disrupted my work routine somewhat. So I will get back to those videos. It's very likely sometime next week I'll do them. The data may be a bit dated because obviously I have to prepare my content ahead and the likes, but you will get those videos. So I'm looking at Red Star numbers. Company operates in the logistics space. They do courier. I think they have cold storage and a few other activities related to the logistics space. Now, revenue wise, decent performance, revenue up 34.3%, profit up almost 60%. The only challenge is that this business is a thin margin business. I don't like thin margins in the country. I don't like thin margin businesses when it comes to investing. My cutoff rate when it comes to investing is to have a profit margin of at least 10%. Ideal numbers will probably be profit margins of 25 30% due to the high inflation environment in the country. So, net profit margin of 2.5% simply means that for every 100 naira this firm has made, 2 naira and 50 kobo was profit. That really is poor. Even though it has improved year on year, um, unfortunately, logistic margins, logistics industry is an industry with high costs and thin margins. So even if you pull up FedEx, which is a or UPS, you'd have the same trend, thin margin businesses. So in terms of dividends, firm has proposed a dividend of 35 kobo. Not bad. Payout ratio is over what? Half of 57 kobo, which is what he made in profit, is 29. So the payout ratio is probably pushing around 60 something percent of earnings, 61.4% of earnings. Now, I also like to look at revenue split. Revenue split tells me where is the revenue coming from, what segment is doing well or otherwise. Revenue wise, bulk of revenue is Korea, which is interesting. One would think with the advent of technology or the increasing use of technology to reduce that, but I don't think that has changed. So almost half of the revenue, if not half, because if you're doing 21.6 billion in revenue, 10.6 is from the courier segment. That's almost half of your business, and that segment is growing well. Probably had the almost best performance actually in terms of quarterly growth, up 40% to 39.94, which is essentially 40% increase year on year. Profit wise, also decently well. Like you see, this just shows you clearly why I say this is a thin margin business, because you can see revenues made and then profit made. Imagine you're doing 10.6 billion in revenues and your profits 27 million. I mean, that's tiny, man. Really, really tiny. But decent growth, only weak spots on the profit perspective, freight and support services. Unfortunately, these firms don't do calls. So the best you might get an explanation from management is when you go to the AGM. You can either physically go or you can attend online. If it doesn't clash with my calendar, I'm waiting for when those numbers come out. I probably will try and attend. It will be nice to see more of these companies come out with earnings calls or come out with earnings releases that give a bit more context or color into their performance. I also tried to forecast the numbers, and so you can see here I have two valuation methods: dividend discount model DDM or discounted cash flows. Discounted cash flow simply tells me what are the value or what will be the worth of this share going by its cash flows in the future. Now, if you use a DCF valuation, you have 10.39. If you use a dividend discount model, which is my preferred model because I think dividends are a more predictable way of valuing companies, especially companies in this space that have a decent history or stable history of paying dividends. So, your dividend discount valuation, and I'll go into that into a bit of context in the next page. It's there and some fractions. So potential upside using that method is about 4%. If you're using the cash flow method, potential upside 24%. If you blend both returns, you have an average price of 9.22. Current price is 8.37. So you have what? Maybe that's 10% or so for the upside. Now, for the dividend discount model, I quite like this, and I wish I had the time. Probably I'll do a standalone video where I look at the different valuation methods and I take a particular stock. Now, for the dividend discount model, it's quite simple. I say, look, what's my growth rate of dividend? What's my required rate of return? I put everything together, and then I get my valuation. And so the last dividend, 35 kobo. My estimated growth rate is 15%, required rate of return is 20%. You add all them, E9, and you can see E9 last dividend multiplied by 1.15. How do I get the 1.15? If you take this and then you add 1 to it, and so you can see the formula there. And so you put everything together and you get your dividend discount model. Now, I must admit that what as I prefer this method of valuation, there's a bit of a downside. Now, if you notice that the growth rate of dividends I used is 15%. Now, why did I use this? Ideally, I could have used a higher growth rate, but your growth rate can't be higher than your required rate of return. And again, your required rate of return, depending on how you look at it, is either you're using an equity risk premium, and if you're using that, that comes down to maybe what, I think 14-15%. But for me, I simply picked 20% because I look, what's a 10-year bond doing? I think it's a 10-year Nigerian bond that is, I think it's that 15 or 17%. Throw in a few more numbers to add to it and you get 20%. If you push this number to what? Say 30%. And we can do the maths right here. If you push this number to 30%, and then you push this to 20%, what does it give you? E15 multiplied by F6, E15 is 0.425, something seems off. That's E15, and then divided by F16. F16 is missing. Why is that the case? This should be my F16. I think I probably will do a separate video on this. So I've messed up my table. Can I get back? Can I get back? Right. So what I was trying to explain was that if you had the only downside of the dividend discount model is if your growth rate of dividend is higher than your required rate of return, then the model doesn't work because your required rate of return cannot be lower than your growth rate cannot be higher than your required rate of return. So if you tinker around with this, you probably may get a higher or lower return depending on what you do. Ideally, one could decide, okay, let me use 10%, and let's see what it gives me. What did I press? Growth rate G 10%, required rate of return 20%. Is it correct? That should be E9 times 1.2. Let's see what it does. This is why I don't like to do Excel numbers on screen. So I will do a separate video explaining the upsides and downsides. But you can clearly, if you think around with this, obviously I had done the 5-year dividend history, and you can see that an average dividend goes up maybe 20%. So I tried to pick 15% to be a bit conservative. So dividend is discounted cash flow method was the better choice to use for this, much as it's less predictable choice, because you can't predict cash flows. You can estimate them, sure, using your baseline, but I mean 3, 4, 5 years from now, cost could skyrocket, something could go wrong, and your cash flows are affected. What the thing about dividends is that companies generally try to be reliable when it comes to paying dividends. So even a bad year, as long as there's cash retained earnings, they try to maintain dividends, or if they cut it slightly. But as much as possible, companies do not like to cut dividends. And this is a firm that has a large chunk of it owned by institutional investors. They also need the dividends as well. Lastly, I said I was going to show you the trade history. You can see that the volumes aren't very high. The stock barely trades 500,000 shares on a daily basis. But for a retail investor, it may not be a big deal, because if you buy what, 5, 10, 20,000 shares, sure, it's easy to get in. But if you're buying a huge sum, you may have to, when you want to exit, you may need to consider exiting in chunks. Because you can see here the last 1, 2, 3, 4, 5, 6, 7, the lowest volume trades were 69,000. So if you're buying 100, 200,000 and you want to exit, it might take you a few days. And imagine if you were to buy 1,000,000 shares of this firm, it might take you what, a couple of weeks to accumulate or exit such a sized position. So I hope you found this useful. I try not to make my videos too long. Do let me know, and have yourselves a great weekend.